Okay, go for it, Allie.
All right, guys. So thank you for coming to our live webinar. We do this every Thursday. I'm so glad that you're here. Hopefully we get some more attendees, but we are here for you guys that are here, and we are on live in other channels. But the two of you right here are our primary audience. So you guys get to control this whole webinar. So that means if you have, oh, Charles gets two too, he's coming in. So if you have any questions, you have any particular pain points of something you're having issues with, please bring that to our attention because we want to help address that and make sure you understand, how the scoring system works. Any questions, maybe even if you had you heard some kind of thing on social media. I've been dealing with a lot of that in the last couple of days. There's a lot of stuff that's on social media that's not true that surfacing. So any of that type of stuff, we would love to help you with that. Okay, so just keep that in mind. And Charles, I was just saying that you are our audience and you're going to control this webinar. So if you have any questions or have pain points or need any specific help, please chime in. You guys can unmute yourself at any time, type in the chat, whatever works for you, and we will respond. But I'll go ahead with the introductions. My name is Alicia Alt. I am a credit expert. I've been in this industry for a little over 20 years now, working in the credit industry as well as lending, mortgages, real estate, all of that. And today I'm with Ivory Becker. We co-founded a software called Credit Score Pro, which we'll talk about as part of the webinar, of some resources that you can use to improve your credit if you need that in that space. But I'll go ahead and let Ivory introduce herself once she gets.
I was turning the light on.
Okay.
Hi, my name's Ivory Becker, also co-founder of Credit Score Pro AI. I've been in the industry about 15 years, so a long time as well, primarily on the regulatory side, dealing with defaults, but also a bit in the lending space as well, and then in the credit restoration space as well. So together we have combined to join forces and create a really, really cool tool. But we like to meet every single Thursday so we can bring more knowledge about credit to everyone, whether it's professionals or just every single one of us basically is impacted by credit. So whoever wants to hear, we want to teach. So that's why we're here today. So without further ado, we'll go ahead and get into today's topic, which is Credit 101. And if you are interested in joining any other webinars, you can check Facebook, Eventbrite, LinkedIn. All of our webinars are listed there for registration. So, and then I don't know if Allie, if you already mentioned this, but feel free. You can unmute yourself, ask questions. I know you mentioned you can ask things, but you can just unmute. You can interrupt us. It makes it more entertaining and enjoyable for everyone. So
Yeah. And again, we're here for you and helping you today.
So why are we here, Allie?
So we're here today to, hopefully the goal is to maybe uncover some myths that may be out there that you guys have heard and you want to know whether or not it's true. Understanding how the credit report works. And also if there is a particular pain point that you are having personally, and you can either say that out loud or put it in chat, and something that we can address in this webinar to help you. Okay, so honestly, the webinar is designed to help you with whatever you need today. So just keep that in mind.
I'll start with a common pain point I see is a lot of conflicting information on social media. So I think we're here to help dispel some of that. I don't know, does anyone else have a pain point or something they're curious to know or learn more about today?
I do actually. Have some clients where they have some issues on their credit regarding derogatories like collections or judgments. And I've always told them, just get a letter and send that in to try to fight it if you have paid it. If it's, you have something to show that you've taken care of that collections or judgment. What I've seen and heard that it's the company or they have 30 days to respond to the consumer, to either remove the derogatory or let you know that you still owe. So I don't know, is that true? Is it 30 days or does it really matter like how long it is for them to respond?
Kelly,
So
wanna tackle that?
you want to answer, Ivory, or do you want me to?
No, you can go for it. Don't matter.
So they get namely 30 days, which in layman's terms would be 30 to 45 days is the response time. Yeah.
So what happens when so if they did respond back to you, let's assume say, yeah, we're still looking to this account, we're still looking into it, which I've seen a lot lately because I know that they do have to respond within that 30 days. Otherwise, if they don't respond, then by law, I don't know if that is true or not, that they legally have to remove it. Is that true?
That is true. Yes.
So if they did respond within 30 to 45 days and they say, well, we're still looking into it, and it keeps sending letters like that, what can a consumer do to say, hey, I've shown proof that this account is paid? Because I'm dealing with that right now. I have a client that we're trying to clear to close on this one, and it's kind of frustrating because the collection agency or the company is just not really helping out at all. Just
Well, I want to say one thing, the paying a collection doesn't itself guarantee that it would be removed from the report. So the investigation would need to get it off of the credit report would need to be for another purpose. Otherwise, it's just more, will you remove it from the credit report because it's already paid versus
Right.
actually disputing for some other type of reason.
Yeah, and that's what we're coming up with now, to where they're just not want to remove it, even though it shows proof that it's been paid, and that's what we're having issues with.
And to kind of piggyback off of what Ivory said, that is going to be a common problem unless the particular company has an internal policy that says, hey, if you pay, we'll remove. So I would be, in my practice, I would not pay something unless I've disputed it, because if I pay it, then I said I'm responsible for this debt.
Right.
By making that payment, I said I'm responsible. If I dispute it and say, hey, prove it to me that I'm responsible, that's where that 30, 45 day mark really comes in, right? That's going to be powerful for the consumer, because if they can't prove it, then it has to be removed. You never have to pay it, right?
Right.
If you've paid it already, you've already said, hey, I'm responsible for this, I did wrong. And then the company either gets to decide if they want to remove it or not. They don't have to. And some companies are great. They have an internal policy to remove it. Oftentimes there's a lot of them that have the opposite internal policy.
Yeah, and that's what I'm dealing with on that.
Yeah.
Make it
does
tough.
not, it does not mean there's no opportunities for removal. It just means you may have to shift the approach.
Yeah.
And
And
what do you mean by that? Shift the approach.
if it was me, and Ivory may have also some feedback on this, but I would shift the approach to finding errors on the credit report.
Oh, got it.
Disputing
Yeah.
to the credit bureaus, not the creditor.
Yeah.
Got it. Okay.
Yeah, I definitely would do that. We typically always recommend going both routes. If it's paid, you're gonna have more possibility of removal. Yeah,
With
yeah.
the credit bureaus, you'll have more success with the credit bureaus. Our software, Charles, may be very helpful in that respect, which is creditscorepro.ai. You can go to the website and see it. It uses AI to create the dispute letters to the credit bureaus, but it's looking at the raw data. And we're going to get into this a little bit more here in a second, but I thought it might be a good point to bring out. It's going to look at the raw data credit report, like what's on the back end, to find errors. And if there's an error, it either has to be fixed or it has to be removed. And I think that's where you might win getting a removal a lot faster than going to the creditor.
Got it. All right. Understood. Thank you.
Yeah.
Very good question.
Any other pain points? I know we took a little side route.
Jamie had one.
Oh.
How can I remove student loans off of my credit report? From the internet, I heard it can be removed. Okay, so let me tell you a little story, Jamie. Student loans are government, we're talking about government-backed loans, probably, most likely, because that's what most people have. They are what I'm going to refer to as the forever loan, unless you get a good opportunity where you can get them forgiven. Okay. They cannot be discharged in a bankruptcy. If you have bankruptcy, you're still going to have the student loan, like all this stuff. So when you hear on the internet that, oh, it's this easy, and I've heard it too, Jamie, just so you know, you can get your student loans removed from your credit report. Can they possibly? Yes, I've seen it happen,
We do
but
it.
that does not mean you don't owe the debt. And keep in mind, and Charles can probably chime in on this, if you go to get a government loan later on down the future and Charles pulls a Kavers report, it's going to show a defaulted student loan. And guess what? You're not getting that government loan. So I would tell you, and they will level your tax return. They have a lot of legal recourse to you. So I would not focus on getting student loans removed. I would focus on making sure they're in good standing and using them appropriately to actually build your credit score. I hope that answers your question. Can they get removed? Yes. I wouldn't do it. There's
So
no, go
I
ahead.
have a slightly different take. Yes, they can be removed if you find issues, if you find errors, but you absolutely can't get out of the debt, just like Ali's saying. Typically, what we'll do is paying them. Typically, what we'll do is fresh start program if they were in default, and then work on the negative accounts that are remaining after the fresh start.
Right. The Fresh Start program is amazing. Now, if you want to get the negatives off your credit report and you have student loans in default, and this, Charles, you're going to love this with the Kavers issue. But if a consumer has student loans in default and they go into the Fresh Start program, that program takes 30 days, at the 30 to 45 days. They'll say 60 days, but it usually is 30 days. The loans would then be transferred to a new servicer. And at that point, they're going to remove the late remarks off the credit report like they never happened. And now we're in a new loan with a new servicer. We get to get back on track. It's beautiful, comes out of default, no longer on the Kavers report. It's an absolutely beautiful program. I'm so happy that it's there. It allows people to get back on track. And it usually they don't even have to make payments while they're in that Fresh Start program, which is also phenomenal. So they're not paying anything and getting into a good standing. And then you back that up with consolidating those loans after it comes out of the Fresh Start program. And then you back that up with getting on the SAVE program if you qualify. So there's steps in getting into forgiveness with those. Awesome. Well, I'm glad. Shauna, did you have anything that you would like to bring to the table?
No, I'm good. Thank you.
So Jamie, I would say for if there are late payments on a student loan in the past, but it's current now, disputing for errors on that late payment notation would be the appropriate way to handle that. So.
And just curious, just correct me if I'm wrong, doesn't most lenders even look at just a 24-month history? So 24-month history being a payment on time, and then prior to that, if you had some late, whatever, probably just need a LOE. Is that pretty much, that's what I run into.
Most lenders, yeah, we look at a 24-month. Yeah, obviously, Charles, you know that. So those who are on here, lenders typically in the mortgage space, especially, it's a 24-month review. However, the credit report spans a lot longer time. So your score is affected, for things that happen, even further than 24 months. But keep in mind that the older it gets, the less of an impact it is on your credit as well. But to what Charles said, if it's past 24 months old, it may not be as big of a problem as you might think it is. All right, so we're going to jump into some other pain points that you may not have said, but we have to understand that credit influences almost every decision we make anymore. And so housing, obviously, Charles, right? Housing is a big one, whether or not you can get approved for it, whether or not what it's going to cost you, what your interest rates are, things like that. So that could be a big pain point. I remember when I got into the industry 20 plus years ago, credit repair was not a thing. People were doing it, but it was really uncommon. You didn't hear about it because you could have a low credit score and get a home loan. But what we found is when people did have credit issues, they weren't even told why. So they were getting denied and then walking away without any help. And that's still very true today because I like to say, and forgive me, Charles, I'm also a loan officer, but not a practicing loan officer. But I like to say that loan officers are, they know enough to be dangerous, right? A general idea about credit, but not the intricate pieces of credit. So they can actually hurt someone when they're indeed trying to help them. And so I think that there's a lack of that. So people are getting denied. It's a big pain point, but then they're like, hey, somebody help me. And then the resources aren't there. And so we're hoping to provide all of you guys on this call with the resource that could help you with that pain point. Employment's like a big one right now, right? People are getting their credit pulled for employment, especially if you're working in any industry that has to do with finance. I know, Charles, you got your credit pulled. I know that for a fact. And that can get you from being able to get employed for that job. So credit scores are really important for that too. Charles, did you want to chime in?
Insurance. Yeah, even like insurance. I tried to apply for a job this is like 11 years ago for State Farm, and they pulled my credit, and I had some dings, but I mean, it wasn't perfect, but hey, I was paying on time, but I had some dings. And no, sorry, we can't hire you. Like, I had clean record, clean DMV, clean everything else except for a couple dings, and I still can get hired on. So yeah, you're right, Alicia. I mean, employment is huge on that, big time.
Yeah, I had a client of mine get really upset the other day because she went on to her credit monitoring and it gave her an employability score. And her employability score was an F. So she calls me up and she's like, this is not okay. Why is a credit monitoring company telling me what my employability score is when I'm a really great employee? I always show up on time. I do my best job. She listed all this out. And I said, your employability score is based on what the industry is saying, whether or not you're going to be a good employee because of your financial ratings, right? Not that you yourself are a good employee. But I bring that up because in your case, you might have been the best insurance agent they could have ever hired, but they did not hire you because of your employability score. So we're becoming more about what our score is than I think we should, right? So it's like mortgages. You get this score of a 580 and it opens the door to get a mortgage, right? For FHA, but it doesn't mean you're going to get approved, right? So we're going to look at everything else. But in the employment thing, it's like, okay, your score is going to get the door open of whether or not we're going to go to the next part of interviewing you and doing this and doing that. So it becomes a gatekeeper. Insurance, the same thing, right? So life insurance is your credit's pulled for life insurance. Your credit is pulled for auto insurance. So if you have a low credit score, you are absolutely paying more on your auto insurance than a person who has good credit scores. So it's, again, a way of keeping people down, right? If you don't have good scores, you're paying more for everything. Utility bills, you're paying a deposit on them that you wouldn't have to if you had good credit. And of course, the big item, can I get financing? Can I borrow money? And if I do, am I going to pay a lot for them? Okay.
It's kind of funny how you brought all this up, these categories, because really at the end of the day, they look at, are you willingness to pay? That's basically what it is. It's willingness to pay. If you say that you make X amount of income per year, but then your credit doesn't reflect that, then they look at you like, then what are you doing with your money? So yeah. It's willingness to pay. But awesome.
Credit worthiness.
Yep.
Right? And then when we talk about employment in that respect, we're looking at the studies found that if you have low credit scores, you usually have financial issues, which interferes with your job. So you're having to do things on the job and or you're getting garnished, which is another big task for the employer to have to worry about and monitor and work on. So there's always reasons behind it. There's been studies behind why they do what they do. But the end result is credit scores influence almost every movement you make at this point in time. All right, Ivory, she's getting antsy with me. I know. All right, what is a credit score? I'm gonna let Ivory do this one so I can zip it for a minute. Oh, you're muted. Your voice isn't coming through. All right, maybe I'll take it from here. So credit score obviously is your credit worthiness, is a good way to put credit score. So it's what's on this report card, and that report card generates a score based on the algorithm. And it shows other people your ability, quote, your ability to pay or not pay a lending. I'm gonna let Ivory, you can go ahead and move on. Can you talk now? No, you can't talk. She did this on purpose. Trust me. So what's the point of having a credit score? What's the point of even caring about your credit score? Obviously, we talked about that, the pain points, right? You have to have good credit to really advance your life. But it shows whether or not you have the ability to pay your responsibilities, and just your reliability. Okay. Ivory, can you move to the next screen? I know you're trying to work on your stuff there. I don't even know if she can hear us, guys.
I can hear you.
You can? Okay. Oh, there you go. You can.
Is it working?
You're here.
I don't
Yeah.
know. All I did was unplug it and plug it back in. Okay.
Yeah.
So I wanted to add one thing to what you said though too. The credit score is really for the lender. I think we often think about the credit score being for us, but it's really meant for the lender to determine whether they want to allow you to borrow. So I think it's a little bit of a perspective shift for most of us, and we take the credit score more personally, but it's really just all data, all statistics. It's not it's not meant to be personal, even though it really does feel that way. It also gives us a lot of opportunity available. There's a lot of opportunity available to change that data, right? To adjust the story that data tells if we just have the tools and the resources to do it. Okay. Now I'm actually going on to the next slide.
Just real quick, I have a question.
Yeah.
It's just real quick question. So you mentioned the credit scoring. What I also overheard is that there are two different types of credit scores. One is for the consumer's credit scoring, and then like you mentioned, Ivory, is also the lending side of the credit scoring. And sometimes you get different scores, and it's kind of like, you know, which one is real accurate. And I know that you mentioned, like, you know, lending has its own little credit scoring method, but then you have the consumers, just a consumer report has its credit scoring. What is like, why, can you explain to us why is it such a big difference between the two?
So
Yeah,
we are
actually,
ready to go into a slide here directly about that. So we're going to answer. That's a really good question, and everybody asked that question. So we are definitely going to go over that. I know everyone's like on their toes, like I got to hear what the answer is. So we're going to get to that here in just a minute, Charles.
and this will build up to it as well. I think what's important to understand with the credit scores is it really starts by putting consumers in different buckets. What type of people are similar to you, and how do you rank against those people that are similar to you? So it's really rank ordering you as a consumer. So somebody who is new to credit, then a thinner credit profile, they don't have a lot of credit history, they're compared to others in that same type of scenario, where someone who has, let's say, 20, 30 years of credit history, you know, they look like a certain type of demographic and they're ranked or compared to others in their profile. And that's really where that credit score begins. That's that foundational beginning. And I'm gonna leave it at that. It does get more complicated than that, but you just think of it as a rank ordering of consumers, where consumers are compared. So lenders know, are we taking on more or less risk based on this type of consumer? So
Here you go, Charles.
there are different credit score models. There's what's known as a FICO credit score, and there's what's known as a Vantage score. So the FICO credit score is the first standardized credit score that we began using. And it's been around for a long time. Well, relatively long time compared to Vantage. Vantage score has been around since 2006. So the FICO credit score was created by Fair Isaac Corporation, which is now known as FICO. That is the name of the company now. And they own that algorithm, they create that algorithm, and then the credit bureaus can use that algorithm. The bureaus wanted to create their own algorithm. They wanted the control. And that's when Vantage score came into play in 2006. So a Vantage score is often, I think the easiest way to know what a Vantage score is when you use Credit Karma, that's a Vantage score. Most oftentimes when you get your free credit score from your bank apps, if you're on Chase, My Credit Journey, that's a Vantage score. So the score itself functions differently than the FICO credit score. It weights certain categories more heavily than the FICO credit score. For example, utilization is weighted more heavily. Other than that, you also want to think of credit scores like, Charles, I'll go into the lending side a little bit more. FICO has different iterations or different models of their credit score. They've got the old one, and then some time passes, consumer behavior changes, so they got to come out with a newer next best, right? Like the iPhones. You get new model, new model, new model. They're all iPhone. They all do the same thing, but they have new bells and whistles. They function slightly differently, right? As each new generation is created. And it's the same with those FICO credit scores. Right now, currently, FICO scores are most widely used for lending decisions. So if you go to apply for a car loan, a mortgage, etc., those are different versions, different iPhone generations, if you will, of that FICO credit score. The Vantage score is new and it's not used in as many lending decisions. It's likely going to change in the future, and we will be seeing some of that change in your industry, Charles, in the next year. But for now, what is used the most is the FICO score. So I don't know if there's anything you want to add to that, Allie. I try to stay kind of high level.
Yeah, I just wanted to ask you, did you have the slide in here that shows the different FICO models?
I don't, but I can stop sharing. We'll just pull it up. Give me a second.
So what I just wanted to show you too, Charles, I think this answers your question. First of all scores are accurate scores, okay? But scores are determined, which score is accurate for which goal, right? So it's really goals. Like, what are you trying to get? If you want to go get a mortgage, then we need to look at FICO 5, 4, and 2, which is an old, outdated system that mortgage lenders are still using today. Okay, so if we look at this graph, I love this graph. If you, where'd it go? She took it away from.
Sorry, hold on.
Okay.
I'm trying to close there we go.
So if you look at this graph, you'll see here at the top, FICO 8 score. This is the most widely used credit score. So pretty much like if you're getting most lending decisions like credit cards and things like that, they're using a version of this score, okay? This is the score, like I said, that most lenders are using. But if we look down, you got the versions of auto lenders, and then you have versions of credit card decisions, right? So these are all going to be slightly different, but all of these are still based primarily on this FICO 8 score. But then you get to the mortgage lenders. FICO 2, FICO 5 for Equifax, FICO 4 for TransUnion. This one right here plays a whole different ballgame. And that's why that's why if someone gets a FICO 8 score, like they went to their auto lender and they got an auto loan, and they come to the mortgage lender and say, well, my score with the auto lender was 650 and you're telling me my score is 600. It's because it's a different version. They're both right. It was right that their score was 650 because they were buying an auto, but it's also right that their score is 600 because they're going for a mortgage, right? I like to use the example of what was it? Verizon Wireless told me my score was it was Time Warner Cable told me my score was 900. There's no such thing in our scoring models that are 900. They have their own score, right? Which is also right. So it just depends on what you're trying to do. This last version, FICO 9, is a newer version. No one really uses that one, so we don't need to talk about it. But you just kind of see that it just depends on what your goal is. What are you trying to do? And that will determine.
Just curious, because this is huge right here. I mean, for this now, it makes sense why they use these formats. How come they don't educate the consumers on this? Because
I agree 100% with you.
That's what we're doing. That's what we're here for.
And the problem even more so, I think, is it's not part of the education of being a loan officer, right?
No. Or a banker or anyone in finance.
But it's a question that you're probably asked a lot, or being told, hey, I got my score from Credit Karma and it said I was 700 and you told me I'm 630.
That's where I'm getting that,
They're mad at you because you're wrong, and they're going to go to the next loan officer who's going to tell them their score is 700, right?
Right.
And keep in mind that we're looking at the different versions of FICO. Credit Karma is using Vantage, right? Vantage has a whole different thing, and usually it's about 40 points or more off from your mortgage one, right? So knowing that, you can then calm the situation down, right? And say, hey, you're right, your score is 700 on Vantage. Unfortunately, we as lender don't use Vantage, or however you want to say that, but that's where I think it's important. And I love doing these webinars, especially with loan officers and real estate agents and consumers also. But if we can be those trusted advisors to people, we really help them, you know, in so many ways. So yeah, I'm glad you.
And now just have a better of understanding it to how it works instead of just passing the buck. You know, now you can really explain it to them like, hey, you know, I understand that your credit score, it says on your report, it says 800 and ours says 700. They're both right now. It's just that we just use a totally different credit report and for lending only. So
and specifically mortgage lending.
Yeah, specifically mortgage lending. Those other industry specific versions are really narrowed in on what's your behavior with credit cards, what's your behavior with auto loans, right? They use the FICO score as that base and then they kind of build off it.
See, but like FHA, like I do with reverse mortgages, that's where my niche is. And so we really don't look at credit scores, but we look at credit history, foreclosures, bankruptcies, collections, judgments, that sort of thing. I mean, we can do a loan on reverse with no credit scores at all. In fact, you know, I mean, it's kind of amazing, really. You know, it's like, what? My credit report has no credit score. No, well, that could be a good thing and could be a bad thing, but good thing we can still help you, and that's awesome. So yeah.
Awesome.
So let's dive into the factors that make up the credit score. So what you see on the screen right now, this is the FICO weighting. So the FICO credit score weighting. And that's specifically because right now, like we had mentioned, we're primarily using FICO credit scores if you're applying for any sort of debt. So we're going to start breaking down each section. We'll start with payment history. Payment history, as you see, is 35% of your credit score. So with payment history, I think we all know if you pay your bills on time, you're rewarded. If you miss a payment, it's going to have an adverse impact on your score. The more delinquent that payment, and it starts impacting your credit at 30 days past due, but the further past due it is, the more negative that impact to your credit score. If you have let's say you had a credit card, it went unpaid, eventually it charged off, and let's say you paid off that charge off, it's still going to adversely impact the score. So one of the things we've heard is closed accounts don't no longer negatively impact your score. That's unfortunately not the case. Now, opposingly, closed positive accounts, so an account you had perfect on-time history with, once that is closed, it no longer positively impacts your score. So you're not getting the benefits of that payment history anymore. I think a lot of times people focus a lot on the negative payment history part, but what's also important is making sure you have positive payment history on there, right? It helps you. So it is about adding value to your credit report too, not just worrying about what takes away from the score. Anything you want to add on payment history?
Just in other words, if we really focus on building the positive, we don't have to worry as much about removing the negative.
Yes, thank you. That was put very well.
Next section. Oh, go ahead.
Oh, sorry. So just, and also too, does it also help too, at least if you have a minimum of 3 trade lines? Does that help?
Thank you for saying that, Charles. That is that is my philosophy because I am a lender too, right? So yeah, lenders, just so consumers know here on the call, we want to see 3 open and active trade lines at all times. I specifically encourage people to have 3 open and active credit cards at all times because credit cards do not close unless for some reason the company goes under or you do bad by that card or don't use it. But loans you will eventually pay off unless it's a student loan. We call that the forever loan, right? But a lot of people are getting their credit hurt right now because student loans got forgiven and they're calling me like, oh, my score dropped 100 points. My student loans were forgiven. Unfortunately, that's happening too. But my point here is that when you keep those 3 open and active credit cards, open and active, you're going to improve your credit in lots of ways. So I do recommend 3 open and active.
That's segue. Segue yourself into utilization.
Okay, so we'll go into utilization. Length of credit history. Is that what we're going in, or am I going the other way?
No, amounts owed, silly goose. Utilization.
Where is utilization on here? Okay.
30%. Amounts owed. They're calling
Oh,
amounts
thank you.
owed.
I'm
so you
sorry. I
can
was
do-
already on that, circling it in my head, and then I moved
Yeah.
past. Yeah, so 35% is your credit history. The other big part that affects your credit score is the 30% credit utilization. Note that credit cards are a big impact in this category. So if you ever feel like you have credit cards and you feel like your credit report or credit scores are a roller coaster, that probably has to do with your balances on the credit cards are like a roller coaster, right? So having low balances on your credit cards is really important. It doesn't have the same respect on loans. Like loans, you can have a $5,000 loan and you owe $5,000. That's okay. But if you have a credit card that has a $5,000 credit limit and you owe 5,000, that's a big no-no, right? That's going to really drop your credit score. The only time that loans affect this category or have much effect on this category, I should say, is if it's a loan where, and this happens with student loans often, you got the loan amount for 5,000, but now you owe 5,500. So you owe more than your original loan amount. And again, this happens a lot with student loans because people go to school, they defer their student loans. I think that's a great thing because, oh, I'm in school, I don't have to make any payments, but they don't realize that they're growing interest on that student loan and it's compounding interest on top of that. It's the worst thing you could ever do is defer your student loans, but people do it because they think that it's cool and they think it's a good thing. But that ends up really hurting someone's score. So I've seen so many students come to me, have great credit, but have all these student loans that are over the original loan amount and their scores are in the 500s. But that's a relatively easy fix that I can help people with if they're in that situation. But most importantly, think about the credit card utilization here. Okay.
Absolutely.
All right. I'm gonna go around to the 10%, I guess. I'm just gonna go around the circle here.
However you want.
Okay, I'm just gonna go around this way. So 10% of your score is new credit. So this is, when you get your credit pulled, those inquiries, right? So inquiries impact this. I won't go real deep level, but there's a lot. And if you have questions about it, let me know, but there's a lot about this section, okay? But credit inquiries, hard or soft. Soft is if you're looking at your own credit or an insurance person is looking at your credit. Those are not hard credit pulls. Those are soft. They're not affecting your score. This 10% effect is for hard credit pulls, like when your mortgage loan officer pulls your credit, when a car dealer pulls your credit, those are hard. Types of credit used, this is your credit mix, 10% of your score. So the credit bureaus are looking, or the credit scoring model is looking for, can you manage, your installment loans and credit cards? Are you able to manage both types of things? So
are you responsible with any kind of debt?
So just to give you a perspective on this, if you were coming to me as a client and you only had credit cards, probably going to advise you to get an installment loan. But if you only have installment loan, I'm going to make sure you get a credit card. Credit cards have a lot heavier weight.
Now, Allie, do we
Yes.
want to get debt just for debt's sake, or are there ways around?
Oh, we have all kinds of resources where we can get debt, but it's not real debt. Okay. But we can open cards that are what we call credit building cards that you don't really, kind of like a debit card. You're really not adding debt to yourself. Okay. And there's also
Same with the loans.
there's loans that you can get. That's actually a savings account that reports to your credit report like a loan. So you don't have to go out and get more debt. That's a great, thank you.
Are you referring to like kind of like a credit card, debit card, but you use your own money? So let's say they give you a credit card of $500, but it's actually your own money, but they're just tracking it to see how many payments you're making, that sort of thing. Like,
Yes
so
and
basically
no.
loading
Yeah.
$500.
There's two different ways you could do it. There's one that's a secured credit card. You're putting a security down.
Yeah.
Security. That really is like, I guess it's not really debt because you're going to get your security back when you close it. But those are just like to help start you off building credit. I wouldn't recommend those as a continuation of credit. But I would say, like, if you've heard of the Chime credit card, that's really not a credit card. That's a debit card that's reporting. Right. Now, I will say that based on my research, it is not giving you as big of a credit increase as if you had a regular credit card in that category. Okay.
And also, too, just real quick, I just want to confirm this because, I have friends where they're trying to reestablish their credit, so they go out and they get like a Chime card and stuff like that, and they said, "Oh yeah, I got a card." And I said, "Well, is the bureau, which ones are you using? Are you using just the single or are you using all three bureaus that are reporting? Because I would assume that you want all three to be reporting, not just the one. And I always coach that to them, because I always like to do your research because you want to make sure that when you get that card, that they're reporting to all three agencies, not just the one. Is that true? Is that right? Okay.
Yes, that is true. You definitely want, if you're going to invest in a credit card, and this gets people in trouble. Ivory, I know, has got stories of this where, they go to a credit union who only reports to one. They don't realize it. Then they go try to get a home loan from a different lender and they're in trouble because they only have one score. Well, you need two scores at least, So it is important if you're going to get credit extensions, it would be best for you to look at some that will do all three. Yeah. Thank you, Ivory, for answering that question in the chat because I was getting ready to, and you got it.
You're fine. I think the most important thing to know is the more variety and the more age you can create on your credit profile, the better. And nowadays with all the credit building tools, you have so much more capability to proactively add information to your report without having to take out a lot of debt. The exception to the rule is always you must have credit cards. Think of the credit score. It's all about how do you pay credit or debt effectively. So you have to have it. You have to have that data in order for the score to back up your history, right? So another thing I think is great about the credit card is you can influence almost every single category if you notice with a credit card, right? You're getting payment history. You're affecting utilization positively if you're using it right. You're affecting the types of credit user, that credit mix category, and you're adding so much age to your credit profile because it's the only type of account that's open-ended, right? It doesn't close after you pay it off. And as long as you're making sure it remains active, which you have to use it at least once every 3 months, Allie's rule of thumb is typically throw your Netflix subscription on there, right? You don't need to be making these massive purchases or using it for every single item you buy in the month and then paying it off. You can just use it for something very small, and then you get that repeated payment history. It's affecting your score algorithm because what happens when you stop using it is the credit score algorithm says we want to be accurate. If we don't have any new data on your spending habits or on how you're using something, we're just not going to factor into your score at all. So I call it stale. It becomes stale, like it's bad data, right? And so it doesn't hurt your score, but it doesn't help your score either. It just doesn't do anything for you. So you have to have it active as well. That's my soapbox for that. I don't know if there's anything you want to add on there, Allie, but length of credit history, really the only way we can affect it is through having something that lasts a long time, like credit cards.
Yeah. So just all said and done, make sure you have 3 open and active credit cards. You could do some credit building things like Chime and those in the secured credit card, but I call those credit building in order to get you to a regular credit card.
Yeah.
And then I would recommend that you end up having 3 open and active credit cards. And here's the way that I make my clients
get
our regular credit card, we get a rewards credit card, and then we get what I call the emergency credit card, typically from a credit union that would have the lowest interest rate. So if I had to put something on the card that I couldn't pay off right away, I'm not paying 34.99% interest on it. Does that make sense? So that's my program is we get those 3 after we built the credit so we can apply and get those. We don't want to, try to get it and then, do the Christmas holiday shopping thing where you apply for every credit card so you can get 10% off and then you find out you dropped by 100 points, right? So that's common. So I thought I'd throw that out there. All right, I think we're good to move on.
Yeah. So thought it'd be good. I'm sorry, that's a little blurry. Geez. Your eyes aren't bad. It's a blurry photo. So thought we'd look at the credit score ranges as well. Now, what's important to understand is these may be the ranges for credit scores, but lenders themselves, depending on the type of debt, what they want to see will fluctuate depending on how the economy is doing, where we're at in market cycles. So right now we're starting to see consumers trending towards more default, more missed payments, and everything else. You live in the same place we live, right? You see what's going on out there. I don't need to tell you. But that means that they start to increase the minimum credit scores they want to see because they see more risk overall with the population, right? So there's going to be times where you have a little bit more flexibility on the credit scores that are acceptable or allowable to get semi-decent rates. But in times like this, you're really pushed up to have those higher credit scores. So you're not getting that car loan at 29%, or that mortgage at 7.5%, 8%. It's everything's all over the place right now. So scores essentially they fall between the 300 and the 850. If you can get yourself in that sweet spot in the mid sevens, I mean, you're perfect. You anything from that point on is really just icing on the cake. You really don't need to have that 800 plus credit score to get those best interest rates for mortgages, for cars, for any other kind of debt, right?
Yeah.
All the credit card rates suck, so I'm not going to mention those, but
I like to say red carpet credit
yeah,
is 760 is what I would call red carpet credit. You should at that credit score get the best rates, the best terms. You buy the car, they give you a keychain and a coffee mug and a travel mug, and you get that VIP service really at the 7. That's why I call it the red carpet. Anything above the 760, like she said, is icing on the cake, unless you are a entrepreneur trying to get business.
yes, absolutely.
And then the higher the score, the better. We would love to see you with the 800s at that point. Okay.
Another thing I'll mention too is if you are in a credit improvement journey, one of the things you're likely to notice is, let's say you're starting off between the 4s and 5. You're going to see bigger jumps earlier on when your scores are lower, and then you start to see it slow down a little bit. Ooh, where's my mouse at? Then you start to see it slow down a little bit as you start to get in these higher scores. So don't get discouraged if you start to get to this point and you're like, well, gosh, I was getting, 50-point jumps every time I saw my score jump, and now it's 5-10 points here. It is very normal to see that happen. So we can talk about why in specific scenarios, but
Is it
know that
because
is
of
very
payment
normal.
history? Is that why? Is that why it slows down? They just want to make sure that you're making the payments on time, that payment history. So, an extra year or something like that, then they'll jump up to that point. Is that
Yeah,
why?
it could be like payment history, past payment history,
Yeah.
it's
Complicated.
If it
It's
didn't
really
come off the credit report, the older it gets, the better your score improves, right? But then the other part or collections or whatever that might be that you didn't get off maybe in the beginning when you're starting your credit repair journey. But then, we're also looking at history. How long have you had the history? And that takes effect, right? So I have an 850 score, and I like to tell people all the time it's because I'm old, right? Some of that has to come with age. You're not just going to get into those really high scores by improving your credit today, and you just started today, right? So understand.
And some of it too is oftentimes if you're in these lower ranges, individuals are afraid of having new credit because of what's happened. So most of the data that the score algorithm is looking at is typically the accounts that are charged off, the collections, and they might not have anything open right now, or what is open only has recent past due payments. So as you're affecting these categories positively, you're seeing big jumps because it's new positive data, right? It's new data that suggests I'm coming out of hardship now, so you're being rewarded in the score algorithm for it. But you're not going to get to these higher ends of the credit score until there's so much good that outweighs the bad, if that makes sense, right? And there has to be, like Allie's mentioning, significant history of that, right? And age is not something we can speed up. There's lots of tools, there's all sorts of things you can do to affect all of these categories, but time is not something we can speed up. Now,
You don't
there
want
are
to,
nuances.
especially for a girl.
There are nuances to it though, right? Like you can retroactively add certain things like your rent to your credit report. Well, now you created age for yourself that's positive, right? So there are ways to do it, but there is going to be a slowing down point where things just have to catch up. or you have to have the ability to get negative information removed from your credit report. And I think how long are we taking? We're taking way too long. So we're going to be really fast. We just got to start making these webinars longer because we just have too much to say.
Well, we can skip this. We've already talked about this. We can move on.
Oh, yeah. Oh, okay. So things rarely discussed. As you mentioned, Charles, this is rarely discussed, right? The different algorithms. So we already covered that, as Ali said. Your credit reports with the 3 bureaus may not match. And I think we did touch on this already as well, right? Not all creditors report to all 3 bureaus. Some creditors choose to report to only 1 or 2. Things like collection companies are notorious for this, as well as those credit unions. It costs money for those creditors, those collection agencies, to report. So they pay the bureaus to report the data. So they're not necessarily going to pay for all 3 bureaus. I think, did we touch on this too? A little bit? Ali, I don't know if you want to go into this at all, or do you want me
I would
to?
just say that, you know, we harping a lot on improving the credit score, but,
Yeah.
and I can say a little bit about this, like Charles is going to pull well, Charles might not pull this because you're doing reverse mortgage, but lenders in general are pulling a CABRS report to see if you have any government default if you are seeking a government loan.
Mhm.
Of course, we're looking at the public record file to see if you had any tax liens or judgments against you. Obviously, you can have a great credit score and that could be a blocker for you. Trying to think of some things.
There's also like a database for rent history for people with limited credit profiles. So some rental agencies will utilize that if you have a limited credit profile, or may just opt to use that instead of a credit score, or this bureau credit score. So
Yeah.
I don't know what else.
In that last category, some creditors will deny you based on too many recent credit inquiries. I do tell people to limit your credit inquiries unless it's something you need, but especially if you're looking for business funding. I know we're not talking about that right now, but business funding is very highly regulated by, or, you know, defined by this category here. They don't like the recent inquiries, a lot of them. Credit card companies, same thing, and other personal loans and things like that. So you just got to be careful about that.
Yeah.
Okay, we can move on from there. I know we're okay. All right, we probably already stated this in some way, shape, or form, but you know, credit report needs to be accurate. There are a lot of errors on it. If we look at a credit report that's 10 pages long, the raw data, the one that you don't see when you're looking at a credit report, could be 500 pages long. So there's opportunity there that there's errors all over it. If there's an error and it's not fixed, it has to be removed, right? So that's where I was going with you, Charles, on that situation you had.
And maybe I'll give an example. Something that you may see is if you pull, I think this is like a common one you can see with the naked eye, which would be you pull your credit report from Equifax, Experian, and TransUnion. Let's say you see a late mark in February 2020. I don't know, making up a date. February 2020 on Equifax and Experian, but TransUnion shows that you were on time in February but past due in January. Obviously, that's inconsistent reporting, right? There's an error somewhere. That's just an example of what you could see as far as an accuracy issue, or an arguable inaccuracy issue. Or they're reporting a late mark when you were never late. You made your final payment on your car loan, and for some reason they marked you past due. They show a balance on a closed account. I don't know. We can go on and on and on.
That actually happened to me. I paid off my truck last year, and then they reported it was late. I was mad. I was like, I got the payoff right here. It's all done, and remove that, man. It happens. All these years making payments on time, finally paid it off, then all of a sudden they hit you with the late payment. Like,
So not fair. But you have a legal right to dispute inaccurate information. And so it's important. One thing that, you know, because I'm going to speed this up a little bit, but Credit Score Pro is the software that we're going to be talking about. And it will find those.
Shoot. Should we skip these?
That's fine.
We'll skip these.
Here we are. This is Credit Score Pro inside of it. So it's going to look at this part of the report. You see this craziness over here with all the numbers and stuff? That's what we refer to when we say
that's the raw data.
And so that's what it's looking at, and it's finding errors. So you don't have to sit there and try to scrub through a credit report and figure out what the errors are, or even understand how to read one. A lot of people tell me credit report looks like foreign language. I get it, it does. You don't have to do that. Credit Score Pro reads that, and then after it reads that, it comes up with the dispute reasons. So it'll indicate, okay, here's all your negative accounts. And then you would just go into your platform and you would click on to dispute the negative accounts. And if you have 20 negative accounts, this person has 16, click on all of them. You know, you might hear on social media, you should only pick a couple. That's not true. And then Credit Score Pro is going to select the reason for you that it believes is either catching the error or is a reason it's sent to the credit bureaus before. Remember, it's AI that it got that item off. So it's a learning system. So it's going to pick either or. But you have the autonomy in here to click on a drop down and make a different decision. The only time I ever recommend that for anyone, because remember, Credit Score Pro is AI. It's a learning system. It's probably going to be better than anything you could have put in this section. But the only time I would ever suggest that you drop that down is if it is truly identity theft.
Yeah,
It's a fraud account, because Credit Score Pro doesn't know if it's identity theft, right? It doesn't know that. But otherwise you would just click on that, leave that selected reason there, and you would hit save, and it saves that. You go through all those, just a bunch of clicking, depending on how many you have. And then it's going to automatically email you those reports with the first page, all your dispute letters, excuse me, your dispute letters. For it'll send you one for TransUnion, send you another email for Equifax, another email for Experian with a coverage page of what you need to do. I recommend that you let it email you, you print those out, and you read the instructions where you need to sign it, write your date of birth, your social security number on it, because the credit bureaus are looking for specific things. They're also looking for that you mailed it from your home address. So when that
They like handwriting too.
They like handwriting too, but when that post office puts that stamp on the envelope saying it came from XYZ state and they want to match that to where you live. Does that make sense? That's where if you've heard on social media stall letters, that's what that's about. It's where the credit bureaus have said, hey, we're not going to look at this because we don't think you sent it. Like someone else is going to want to help improve your credit unless they got paid for it, right? So that's best practices. However, we live in an age where there are a lot of people, and I've had people tell me, I have never bought an envelope. I don't know what a stamp is, and I don't know how to put the envelope together, right? Like they just don't do that stuff. So we have an integration here with a company called MailDash where you can click and have MailDash mail those letters out to you. Keep in mind the way that the way that I told you before, is best practice, right? But you can legally do it in all different ways. So they can mail those for you. They charge a small fee, nothing big. And sometimes for the hassle of printing it and mailing it and all that, if that's a big deal for you, it's probably better just to go that route. All right, you can move on from here.
Allie, what about everything else that affects our credit scores, not just the negative information?
And we talked about this. We talked about how, we can talk all day long about let's remove the negative stuff, but if we're not putting positive back into it, then are we really helping the situation? The answer is probably not. Okay. So what Credit Score Pro does is it's reading that same report. It allows you to select a goal. And when you select that goal, it then creates a detailed plan for you based on what's on your credit report. So it's going to decide, do you need a credit card? Yes or no? Do you need an installment loan? Yes or no? It's going to tell you those things. And then it's going to also give you the resource so you can get those items. So you don't have to go try to find out, well, who's going to give me the installment loan? Who's going to give me the credit card? Like it's all embedded in there to help you make the right decisions. And the reason that is the case is if you have a 500 credit score, it's going to be really hard for you to get lending. So we've already embedded into the plan the lenders that would give it to you. Does that make sense? In most cases. We also have credit building resources that are on our page. So these are resources that we've vetted that we believe will help. Those are some of the plans that would be also in your tailored plan. So it's best to go to your tailored plan, look at what it's telling you to do, because it's based on your goal and your credit report.
Okay. And one of the things I would like to add too is your credit report every month when you make these disputes, your report automatically is uploaded and scanned and reviewed. And then it'll let you know what's been removed from your credit report. It'll have you create new disputes. And then the action plan is automatically updated as well. And then you have the option to change your goal whenever you want too. So you can do as many action plans as you want. And once you complete a step, it's going to tell you, it's really small right here, but it tells you, look, good job, you completed that step.
Now,
And it'll tell you the next ones. Go ahead, sorry.
Each month you'll get a new report, and it's going to show you the changes that have been made, what you've accomplished, what you haven't accomplished. If a new collection pops up, it's going to indicate that, right? So it's a live document. What I do like about it is it's not just for bad credits. You see at the top where this person has good credit scores. It's not just for bad credit. It's also looking at other factors. This person wants to buy a house. Do they have a savings account? Are they saving for that? That's a criteria we like to look at as lenders, right? So it's not just for someone with bad credit. I think that's important to know.
Yeah, and see, this one even recommended at the bottom, activate cards, right? So when we were talking about how data can become stale, so it's not factoring into your score anymore, it will remind you, hey, you haven't used this card, it's not helping your score. You've got some point potential here. So it's really cool. What about financial literacy?
Yay.
So I'll talk about this one a little bit. This section is really what we've done here today, but like amplified times 100. So we've built into the platform different modules that start with the basics of breaking down the credit score factors, understanding your rights when it comes to credit, what creditors are allowed to do, what the bureaus are allowed to do, and how you are protected. Because I think we often know what they get, but not what we get. And then learning exactly how do you read your credit report? What are the myths from social media? And what's the actual truth? And then we look at those different credit profiles, how to establish credit, how to reestablish credit, and everything in between. So it's all broken down into about 5 to 10 minute videos. So you can pick and choose what you care about. There are sections that go into all those algorithms too, if you're curious to learn the differences between how those algorithms function. Oh, and I think that's it.
And I just wanted to say something else about that.
Yeah.
The modules were originally created for lenders.
Yeah.
Lenders would go through these modules as a course to learn about credit so they could be a trusted advisor. So we have a lot of lenders that use our platform and get a Credit Score Pro account just for this part, just so they can go through the courses so they could be that trusted advisor. So I just want to point that out. But it tells you everything you need to know about credit or don't want to know. It's pretty in-depth. All right, so you can visit us at creditscorepro.ai. I want to just point this out. Credit Score Pro software is free. Free with a capital F, capital R, capital E. What you're paying for when you sign up for a Credit Score Pro account is just to connect it with credit monitoring. And we partnered with a company called Smart Credit, which also offers a bunch of benefits on their platform. But you're paying for credit monitoring. So when you pay for credit monitoring, you get Credit Score Pro. And if you are not paying for credit monitoring, I'm going to tell you now you want to pay for credit monitoring. And I'm going to tell you a couple reasons why. If you connect, you get your Credit Score Pro free account. We can't really do much without connecting the credit report because we need to see one, right? That's what the system's all built on, is looking at the credit report. But it has the integration with Smart Credit allowing us to have that raw data. And so because of that integration, Smart Credit charges a fee of $39.99 for their monthly Smart Credit. Okay. On the Smart Credit platform, though, it has a couple very important things. So this is above and beyond Credit Score Pro. Smart Credit gives you a $1 million insurance policy for free with their membership against identity theft. And I'm going to tell you, everybody better have this. My identity's been stolen twice. A couple of years ago, I was out 7,500, something like that. I got most of that back with painstaking time, but 3,000 I didn't. If I had that insurance, that would have protected me from that loss. And that's free with your credit monitoring. So that's one of the big reasons I tell everyone you must have credit monitoring. It's not even an option anymore. And you don't want the free versions because you don't get the benefits. The other thing that I really love about Smart Credit, what they have is they have what's called Privacy Master. So it's constantly scanning the dark web and other websites that are selling your information. And if you ever go to one of those sites and pay for what they're selling about yourself, you'll be horrified. Someone
Yeah.
can pay a very small fee for and get about you. And I mean, you will be horrified and probably embarrassed that someone could get that information. But that's on these websites, and you can click to have Smart Credit remove it. You can also go on Smart Credit and it will alert you on when's the best day to pay your credit card.
This is my favorite part.
Yeah, it's all my clients' favorite part. That's their very favorite part. They
I
get an
like
email
that part because
that
you get a
says,
score boost from it.
yeah, they say, here's the best day to pay your credit card by. And why that's important is, let's say Charles is, and I know Charles, you do reverse mortgages, but I'm going to use you as an example because you're a lender, but he's going to pull your credit report and your credit limit was 500 and you owe 500. Well, Smart Credit's going to give you an email that says, hey, if you pay this down by this date, when Charles pulls it on this date, it's not going to show that you were maxed out. Does that make sense? And so that's a real popular one. So you can, if you needed to max out your credit card, you have a date of when you should pay that back down, right? Really cool. So that comes with Smart Credit. But I just wanted you to know what Smart Credit gave, because I really think people underestimate the fact that having credit monitoring is really important. But then
But you know too. You
get
know
to-
too if something happens, right?
personal experience, right? Personal experience. And it's not just my own personal experience. I get the phone calls all the time.
Yeah.
And I'm like, man, if you would have had Smart Credit, they would cover this. And, and then identity theft is often done through those sites where they sold your information. So you're putting yourself at risk by even having your information there. So long story, but credit monitoring is important. And guess what? You have credit monitoring, you get all those benefits from Smart Credit, and you get Credit Score Pro. I mean, it's a no-brainer, right? So I just wanted you to know. But one thing I do want you guys also to know, we do have a Facebook group that's at Credit Score Pro, the AI Credit Revolution. We love for every consumer to be on that, every professional be on that to answer questions and ask questions, and we're there for you on that platform. The more interaction we get, the better that platform is. And then of course, we're here every Thursday.
So I do have a question. A great presentation today. So just let you guys know, it's really great presentation. One of the things that I get asked a lot is parents trying to get build credit for their kids. And, back in the old days, well, I'm going to be 50 this year. And when I was a kid, well, I didn't have no bank account when I was 3 years old or 5 or even 8. When you turn 18, like, okay, let's go down to the bank and open an account. Well, now I get asked a lot, from clients, friends, mainly friends, and say, hey, I want to open an account for my son. He's only 4. Can I do that? So yeah, why not? What's stopping you? I mean, I'm assuming because the goal on that, and this is why I told him, I said, you're helping him establish credit early, but also you're educating him too on how to make payments and stuff like that. So it's a lot of hit and miss because people think like, well, if you do that, then you're going to get them into debt. Well, that's not true, but unless you're responsible, if you're not responsible, then yeah. But if you're teaching them to be responsible on how money works, I think it's the best way to do that is actually do open up an account for them and show how you make deposits, how to pull money out, how to spend it, what put back in there, and that sort of thing, receipts. So show them the positive way. But what's your guys' take on that? Because I get a lot of mixed, like, you shouldn't be doing that. And what's your guys' take on that? On credit, on building credit for kids?
Typically, they have to be at least 16 for most accounts in order for them to be authorized in any capacity. There are debit cards that are made for younger kids, though, to help them build the habits. But I personally, my dad put me on a credit card when I was 16 to teach me how to utilize it and not get myself in trouble. But it's his account, right? As a minor can't own their own account. It wouldn't be their account. They can be authorized on an account.
Right.
Yeah, and I have a little spin on that too. So I did make my children at a very young age authorized users on my credit card.
Mm-hmm.
They're still to this day, and I got one's 27, one's 25. They're still an authorized user on that account. And they always joke with me like, don't close that account because you're going to crush your credit. right? Because they have this long history. So they have these really high credit scores because they have this really long history of credit way before they could even establish their own credit, right? So yes, they got an incentive because of that, right? They're getting the better rates for different things. So I would say that I feel like that's an acceptable way to help a child build credit. I did hear a philosophy that I really liked recently from a friend of mine. And he said, yes, give them that authorized user account, but wait until they're 18 because they're still going to get your history at 18, but they can't get any lending until they're 18. So make them an authorized user when they're 18 because you want to try to keep your child's information to being out there in the world to be stolen.
That was
Right.
interesting.
And
Yeah,
I
I thought
really
that was
agree with that philosophy because
Yeah.
identities are being stolen so often and kids' identities are being stolen, sometimes by their own parents.
Yeah, I agree.
Yeah, but you can give them that authorized user account when they turn 18. They don't have to be, 4 years old or whatever that might be.
Yeah.
Have that and still get your history. So I would suggest that. I think that's a good practice, especially today. I think back when I did it with my kids, identity theft wasn't that big of a deal. We didn't talk about it. We didn't hear about it. It's a big deal right now. So if we can try to avoid our kids' information getting out there, I would recommend that. Now,
Yep, I agree. Yeah.
that being said, I can teach them how to use credit with my credit card, right? I can say, designate, this is my credit card, but this is the one that you get to use and manage, and you got a job and you're going to pay this credit card, and I did that with my kids on their authorized user. They got to swipe that card, but they also got the bill.
Yeah.
You know what I mean? And so it taught them some rough lessons at first because they were swiping it all the time thinking, oh, that's great, right? So you could teach them off of your own card. And obviously there's many other ways of teaching money habits, but I would say I agree with my friend on the philosophy of trying to keep their information hidden until they turn 18.
Yeah. Good. Awesome. Thank you.
Very welcome. That was long-winded, but well, I appreciate every one of you on here and anyone watching on our live streams. We are so excited to do these webinars every Thursday. We hope it was very valuable for you, and we're always here for you. So please get on our Facebook page and you have additional questions, message us on there. Did you know creditscorepro.ai? Our email address is on there too, so you can always email for questions. But if we can
let's see, what's our next event?
She's going to tell you our next event.
Our next event, what is today's date? Today is the 16th. Our next event is actually a lender event on May 23rd, so next Thursday. Credit strategies for real estate and banking professionals. And then the next one after that is all about AI. So the Thursday, May 30th is all about AI and really just deep diving into the AI side of things, what AI is doing in the credit space.
I probably recommend going on all of those. They're all
You really are.
Yeah, but check out Facebook, or like I said, the other ones. I have the events posted for us through August, so you can register away. But otherwise, we do appreciate, like Ali said, you guys coming this Thursday. So
if you follow us on Facebook, you'll get alerts about the things that we're
yeah,
doing.
that's true.
All right. Well, we're over. We appreciate you. Thank you so much. Have a beautiful evening.
Thank you.
Thank you, you too.
Thank you. Bye-bye.
Okay, Ali, I'm going to stop the recording.